My name is Eric, this is my co-founder Adam, and we want your money. Why? Because we believe we have created a better, cheaper, and more convenient way to get your money managed. We all worked in financial services for a long time and thought, how should an investment management service look like that we would use ourselves and could recommend to our friends and family? Or to put into other words, a service so cost efficient, so honest and transparent that even a banker could use it. Our answer is Scalable Capital.
So what is Scalable Capital? We are your digital investment manager. We build and manage your globally diversified ETF portfolio, and we do all the hard work for you. Now, I know the first question that everyone's going to be asking, does the world really need another robo? Well, we're here today to try to demonstrate to you what makes us different. And where we fundamentally differ from the traditional wealth management world and the other players in this market is in the way that we manage your money. We've developed a risk management technology which was previously reserved for institutional investors, and we're really excited to take this technology and to put it in the hands of retail investors. So let's deep dive now into the heart of what we're doing.
After the onboarding questionnaire, where we determine your risk tolerance and ask for your financial status and knowledge, you will arrive at the investment planner. You can now select your lump sum investment or monthly recurring payment, but the most important thing, you can select the specific risk you want in your portfolio. And our portfolios don't use vague marketing descriptions like conservative, moderate, dynamic, because at the end of the day, that doesn't tell you anything. What's a moderate portfolio? Can I now lose half of my money, more or less? And will this moderate portfolio always stay moderate in all market conditions with its 40% equity, 60% bonds? What we do instead, and this is truly unique for private investors, we quantify the risks and we attach an institutional risk measure to it. We use value at risk for each portfolio, which gives you the maximum loss that won't be breached with a 95% likelihood over a one-year horizon. And you can now select, for example, a very low risk category. We start at 3%, which gives you quite a narrow range of outcomes. Or you can select a higher risk category, such as 20 or 25%, which will increase your expected return, but also increases the range of distribution, both on the upside and the downside. And why do we stress this risk point so much? Because risk, apart from costs, is the most important factor in investing. Risk is the currency you buy long-term performance with. And our clients should decide themselves how much of that currency they want to put on the table.
So, how do we target this specific client risk? How do we control risk? We make risk projections on each and every client portfolio. So that on the left-hand side here, whenever we observe that their risk tolerance has been breached to the downside with the risk projection we're making, we automatically adjust the portfolio. For example, moving out of high-risk classes like equities and getting into lower-risk classes like government bonds. So that in the right-hand example, you can see that the portfolio is now being adjusted, and the new risk projection that we're making no longer breaches their lower risk limit. This is fundamentally different than how it works if you were to be in a world of model portfolios with static weights, for example, 40% bonds, 60% equities, and you were rebalancing to those weights. We don't care for these static arbitrary weights. What we care about is the real level of risk in the client's portfolio. And what you can see here is our historical allocations into different asset classes for one of our risk categories. This is one of our higher risk categories at 20% value at risk. And at times of market stress, you can see that the allocation from the riskier asset classes like equities have flipped almost completely and into lower risk classes. The portfolio can shift from 100% equities completely into 100% government bonds. Just because the risk in the market is constantly changing, it doesn't mean that the risk in your portfolio should as well.
So how does this look below the hood? This is what the risk management technology does. For each individual client portfolio, we run simulations daily. taking into account the risk level that you've chosen, transaction costs, taxes, and other factors. And we manage your money according to our technology, which is all cloud-based. And the most important part is you don't have to do any of it. So don't be confused by the complexity. Yeah? It's everything the client needs, he sees on our easy-to-use front end, where you have full oversight of what happened with your portfolio, what are the trades that we've done, but you don't need to do it. The service actually is quite non-interactive. Once you are a client, we do everything for you. We select the best ETFs, we change the asset allocations. And that might be a lot of talk, but the best thing that could happen to us is what happens right now, a huge crash. It's absolutely lovely. Static portfolios down 10, 15%, brilliant for us, because this is where we can show that our technology, our risk management technology differs.
So where have we come from? What's been our journey so far? It all started in early 2015 when we got our seed funding of 4 million euros. Back then, we were a founding team of 5, 4 straight off of the Goldman Sachs trading floor, and 1 professor of financial econometrics. And we've since grown to a team of 30, with offices here in London and also in Munich. We've been live in Germany for 2 months now, and we're really proud to announce today that we've just received FCA approval. So I really invite you all to please visit our website, join our waiting list, and be part of what the first group of people to access our service here in the UK. Hopefully, we've been able to demonstrate today that we're taking the tech in fintech very seriously. We're not just providing a new distribution channel for selling old-world financial services or products, but we're using technology in the most important part of investment management, which is in the way that we manage your money. Thank you very much for listening.